Many investors have recently been paying close attention to residential properties. With the proposed changes to negative gearing and capital gain tax, many people are starting to recalculate their property investment returns. But there is one thing many investors may not have realized. Commercial property may be coming back on investors' radar. Why is that? Hi everyone, I'm Len, your trustworthy accountant. Today, let's talk about why commercial property is being discussed again. First, the tax treatment of commercial property differs from the residential property. Commercial property usually involves rental income, operating expense, loan interest, depreciation, GST, and BAS reporting. If the ownership structure is properly set up, there may be room for tax and cash flow planning. The ATO also explains that in certain situations, when you purchase commercial property, you may be able to claim GST credit on the GST included in the purchase price and related costs. Second, many investors are now concerned about the restriction on negative gearing for residential property. So naturally, some investors are asking, apart from residential property, are there any other asset classes worth considering? Commercial property is one of the options being discussed again, but here is a key point. Tax benefits do not automatically mean the investment itself is good. Commercial property may look attractive because the rental yield can be higher, the lease term can be longer, and the tenant may also pay part of the outgoings. However, the risks are also very real. For example, vacancy periods can be much longer. If a residential property becomes vacant, there is usually a larger pool of potential tenants. But if a commercial property becomes vacant, it may take months or even longer to find the right tenant. Another risk is the oversupply. This is especially important for office properties. The Australian office market still have a relatively high vacant rates. According to Property Council data, the national office vacancy rates increased to 15.9% in January 2026. So is a commercial property worth looking at? My answer is yes, it can be worth looking at. But you can't look at the tax alone. At a minimum, you need to consider 5 things. First, tenant quality. Who is the tenant? Is their business stable? Do they have the ability to renew the lease in the long term? Second, the lease terms. How long is the lease? Is there any option to renew? How does the rent increase? Who pays the outgoings? Third, vacancy risk. If the tenant leaves, how long might it take to lease the property again? Fourth, local supply and demand. Are there many similar commercial property nearby? Are there any new developments coming to the market? Fifth, tax structure. Should the property be held under an individual name, a company, a trust, or an SMSF? Different structures can affect GST, CGT, lending, asset protection, and cash flow in very different ways. Tax benefits are only a bonus. The fundamentals of the investment property are what really matter. At FABC Accounting, we specialize in QBCC compliance and tax planning. We help clients optimize their asset structures and respond to budget changes. If you would like to understand how this reform may affect your situation, feel free and book a consultation with us. Don't forget to click like, save, and follow.